Good day, fellow investors. Today we are going to talk about why it is a good idea to start considering shorting stocks in your portfolio. And even if you are a value investor who is focused on going long on stocks and you are a safe investor, you don't like risk, it's a good idea to consider shorting. Okay. So as many of you know, when you are a small investor, you tend to leverage more your portfolio. If you are a professional investor who can get phenomenal returns like 50% a year, okay, which is definitely doable in the stock market, it makes sense to leverage your portfolio to borrow money from your broker at a 6% interest rate per year and to make 50% on that money. It makes sense, but you have to be careful. Okay. Now, if you do have leverage in your portfolio, you must have a hedge. If you have more than 1.5x leverage, meaning you borrowed at least 50% of the value of your portfolio and you invested that, you need to have some kind of hedge in your portfolio in order to avoid a margin call and wiping out your entire account and money. Okay. Now, there are different options to hedge your portfolio, but shorting stocks is definitely the cheapest and it is even profitable. It might be very profitable. Not only that it hedges your portfolio and makes it safer, but it can also increase your returns. Okay. Now, first of all, what are the main alternatives to hedging a portfolio? The most obvious and common way, which a lot of hedge funds do use it, is buying options. If you have only long position portfolio, you should buy options on those stocks, put options in order to hedge your portfolio. So in the case of a downturn, those options will compensate for the losses and will keep your portfolio safe. The other option is diversification, and another option is timing the market. Now, let's talk about buying options. Buying options almost always will cost you a lot of money. Okay, you're gonna lose. It's actually an insurance that you buy on the stocks that you own, and it is almost guaranteed that you will lose this insurance money every year that you hedge your portfolio. For example, let's look at an example at at a company called PepsiCo. Now, today, the date of today is August 6th, and the price of PepsiCo is $139. We are looking at an options chains chart, which shows the options that expire in 1 year from now, in June 2026, approximately 1 year, 10 months. We can see that a put option for the price of $135 costs $9. So in order to purchase this insurance, actually, you have to pay $9 per share, which is approximately maybe 8%, maybe 7%, a little bit more than 7, maybe 8%. So we can see that if you own PepsiCo on leverage, meaning you borrowed money and you bought this stock, if you decide to go with options, you're gonna have to pay 8% of the position every year. In addition to the 6% you're already paying for the leverage, for the loan. So basically you're gonna lose 7 to 8, maybe 9% every year to hedging this position. Okay? So it costs money. Another way to hedge is diversification, meaning You diversify your portfolio a lot in hopes that the diversification will allow you a lot of leeway in your portfolio. And even if there is a market downturn, your portfolio will be much more stable. But diversification is not perfect. It can definitely help hedge your portfolio and help mitigate risks and downturns. But as we can see, in 2008, the S&P 500 went from 150 to 75, which means it went down by 50%. Now, if you were leveraged at those uh, at that time, you would have been margin called and lost your entire portfolio. And there's nothing more diversified than the S&P 500. So this is the most diversified instrument, and still it went down 50%, which would have been wiped out your portfolio. Okay, so diversification is important, but by itself, it's not enough. It's also worth noting that it's risky to short. Okay, shorting is risky. You can't just short any stock. You have to do thorough research and do your homework to decide which stocks you want to short. You want to short very specific stocks that are not, let's say, meme stocks and all the time in the news that can go up without any reason. You want to short companies that are doing badly, the revenue is going down over time, and you believe that the business is not sustainable. You have to do your homework. This is key. Never short anything without knowing the reason why you are short. Okay. Also, diversify your short positions. Never put too much of a big position on one short, and it's that you must diversify your short positions. And lastly, be patient with shorting. Even if you're not making money on your short position, even if it's underwater, it's in a loss, keep it. It's a good hedge because when there's a broader market downturn, okay, your short positions will also go down, the stock price of them will go down and you will make a profit. So it is worthwhile and it is a good idea to keep those short positions in case of an emergency, like a broader sell-off in the market, like COVID and the 2008 financial crisis. And that's it for today. Um, Even if you are a safe, only long investor who likes to buy bargains and value, consider shorting. It's the cheapest and the most efficient way, in my opinion, to hedge your leveraged portfolio. Thank you for watching.